Welcome to Real Estate Investing Abundance, the show for busy, fulfilled professionals like you to learn how to develop financial independence built on solid, passive real estate investments. Now, here is your host, Dr. Alan Lomax.
Hello, enlightened investors. Welcome, and I'm delighted that you are joining us for the launch of our new podcast, Real Estate Investing Abundance. 3 times each week, we will bring value bombs of investment wisdom from the most successful and renowned experts in the industry. The focus is on passive investment in real estate to help you as our listeners develop financial independence to live life abundantly. If you enjoy the show, please take a moment, find us on Apple Podcasts, and leave us a review. Reviews are vital to growing our audience so we can help more people find their avenue to financial freedom. Each week for the first 4 weeks, we will do a drawing of all those who submit reviews. The winner of the drawing will receive a $25 Barnes & Noble gift certificate. So please go to Apple Podcast and leave us a review. Enlightened investors, I'm your host, Dr. Alan Lomax. We have tremendous value for you today as we bring back another superstar from our Creekside Chats podcast. Our guest brings us the wisdom of over 25 years of real estate investing. As a young man, I was fulfilled in the work of my calling as a university professor and administrator. Funds were automatically pulled from my paycheck for my retirement savings, and I had some small apartment rental investments on the side. Being happy and fulfilled, I didn't give much thought to developing true financial freedom. I wished I'd known 30 years ago what I know today. That is why I founded Steed Talker Capital, so that you, as young, busy, and fulfilled professionals, can develop financial independence now rather than later. To learn how you can follow your calling and at the same time develop financial independence, go to our website, steedtalker.com. Get your concise one-page guide to the 10 proven steps to profitable passive real estate investing. Not only has our guest Mark Kenney invested in real estate for over 25 years, he is also a coach, mentor, and the co-founder of Think Multifamily, a leading multifamily acquisition education company that prides itself on a family-oriented approach to investing. With over 7,500 units under management, Mark brings a wealth of information and knowledge to busy professionals seeking to learn how to wisely and profitably invest in solid, passive real estate investments. Mark, before we delve into passive real estate investing, share a memorable experience from your formative years that helped you to be the person you are today.
Yeah, thanks for having me, Alan. I really appreciate being on again with you. My childhood, I think we grew up with a place to live and food, but we had a lot of things that I probably wanted as a kid that we didn't have. So frankly, at a pretty young age, I was actually money driven. It's different now, but I was. And that's what gave me the drive to say, I don't want to have to go through some of the pain and suffering my dad went through as well, and family, right? As far as he would spend weekends and nights working on washers, dryers, cars all the time. As far as a memory wise, I remember my dad spending all his free time. He'd be gone up to 100 hours a week because he was a firefighter and then worked 40 hours at the lumber yard as well. And didn't have a lot of spare time, but he spent most of his spare time working on things that were broken all the time.
I know how that goes.
Yes.
A good motivation to get into real estate investing. Give us a 360-degree aerial view of why anyone in the world would want to invest in real estate.
Yeah, so I'm an investor just actively, but also passively. But some of the advantages I see, it's physical. I can touch it. I can go drive by it. Where a lot of investments I was making before, similar to what you mentioned in the beginning of the show, I had a 401k and things like that when I worked for corporations. But there are a lot of things that go on there you have no control over, and world events that happen that really should have no bearing on certain stocks, still do. But with real estate, at a young age, I was 22 and bought my first property. Like I said, I was analytical mind-wise. I could touch it, I could feel it. There are tremendous tax benefits. We haven't paid any federal income tax for several years, which is great because of the depreciation benefit that can come along with investing. And then in syndication, where fancy word for someone putting a deal together, raising money from multiple people to partner together to buy larger properties, you get the economies of scale, try to spread your risk around a little bit that way as well. And then you're, unlike a stock where you don't really have access to typically the people that work at the company, like the CEO or anything. If you invest in a syndication, you generally have access to the main, if you want to say manager, CEO of the project, and can call and ask questions and things like that. So those are some of the main reasons. The other one is the loan terms that we're getting right now are crazy good. So the leverage is really high. So those are some of the things that we like about it. And then without going into all the details on it, if you buy 5 units and above, it's treated as a business. And along with that, without explaining it all in detail, is that you can have exponential growth in your net worth and your income and things like that, because every dollar you increase your revenue or decrease your expense is a multiple of that. Let's say it's $15 to $20 for every dollar I can increase my revenue or decrease my expenses. So those are some of the benefits in my mind through multifamily investing.
Thanks for that, Mark. There really is probably no such thing as a totally passive investment. Even if you are invested in Wall Street, you're going to have to watch those stocks and bonds and be sure that they're doing what they're supposed to be doing. But that's even probably more true if one wants to grow their wealth to a level where their investment income is their primary source of income. So just the basics here. How can a busy, fulfilled professional engaged in their calling at the same time develop a passive stream of income through real estate investments?
Yeah, your point as far as no true 100% passive is definitely correct. There is a pretty substantial difference between an active person putting a deal together and someone that invests in their deal as a limited partner, but you should become educated and knowledgeable no matter what. I don't care what the investment is before you invest. So alongside of that, there's a lot of podcasts and books and things like that. And we also do some different training that goes through some of the, if you want to say, tricks that people play in order to make a deal look good. You don't have to be the expert in every aspect of it, but I would say get educated first before you invest, because you're investing typically $50, $75, $100,000 in that small amount. And don't do it blindly. But meeting different syndicators, putting deals together, it's pretty easy once you find a deal and you're able to vet it, which you can get pretty good at vetting the deal itself. Investing is pretty painless, right? You fill out some paperwork, wire funds, and you're in the deal. But the more important thing is vetting the sponsor or the person putting the deal together. That, in my mind, is more important than even the deal itself. And that's where it can take a little more time. It's a small world. You can ask around people's reputation and things like that. We have a number of questions too on our website. You can go download and ask different sponsors or syndicators questions along those lines as well. So I think first and foremost, get educated before you invest. You might decide, hey, it's not for me. I don't like it. Okay, well, you know that now. If you decide you like it, try to get people that you know and trust, ask around the industry, get pretty familiar with being able to vet a deal and a sponsor, and then make a decision to move forward. And a lot of these deals, you have to move fast because they fill up quickly sometimes as well. So you need to have all the education and have your money ready to go ahead of time, not necessarily wait until the last minute to do it.
Yeah, those good deals go pretty quickly, so you really do need to be on your game there. Let's just break this down for the novices that are listening. So first of all, just give us an overview of what a real estate syndication is.
Yeah, so real estate syndication, just really a fancy word. Let's assume Alan has a deal. He finds a 150 unit deal, and he's going to lead on it, right? He's finding the deal, he's analyzing the deal, he's probably getting the lender lined up and the property management company and attorneys, everything lined up. And let's assume that I'm the limited partner or an investor. Well, Alan would have a deal and he'd push it out and I would look at the deal. Alan's responsible. He's the general partner or the manager or syndicator, whatever you want to refer to him as, but he's leading the deal. He's on the hook for trying to get the deal to perform and things like that. And again, orchestrating, he's putting money up as well for earnest money, which is typically 1% or more of the purchase price, which you might have a few $100,000 out there. So he, as a general statement, on the hook for making all that stuff happen before I even get to it. He's also responsible for working with the attorney to get all the legal docs in place, typically a private placement memorandum or a PPM. There are 100 things that have to happen. A couple of things could go wrong, blow the deal completely up. But once Alan's done all that and he pushes it out and I look at it, I then, as an investor, will review the investor documents to see if it meets my criteria. If it does, if you have a portal, we use a portal, but you don't have to. In the portal, you can fill out the documents right online, sign them, and then I would fill out the paperwork. Alan would look at that and review it, and he would either approve or reject it. If he approves it, I receive a notification and I wire my funds. And I'm not in the deal until I wire my funds. So that's another important piece. You have to wire your funds in order to be considered in the deal. Filling out the paperwork by itself doesn't get you in the deal.
Just opens the door to getting into the deal. We'll be right back after a word from our sponsor. As an industry-leading, relationship-focused, design-build construction firm, Mosaic Construction has worked in many different asset classes from multifamily to retail, medical, industrial, and commercial. Mosaic Construction works to execute interior and exterior renovations with their team of trades and project managers. Their experience with value-add improvements has resulted in increased ROI and long-term value of the assets. They work nationally in partnership with local trades to deliver thoughtful, problem-solving construction management solutions to all their clients. For a personal, no-obligation consultation, call Ira Singer, 773-491-3145, or email Ira at mosaicconstruction.net. You can also find Ira on LinkedIn. Thanks for that explanation. That helps a lot. Well, we're talking about private placements here as opposed to public offerings. One of the first steps in being able to invest in a private placement is actually finding the private placements, which you can't just go to the internet like you can with a lot of stocks and look at the stock market trading for the day, because you're not going to find it there. So how can a passive investor go about finding these real estate investment opportunities?
If you go to events, that's a great place to meet people that syndicate deals, because you also get to meet them kind of face to face. There are some kind of crowdfunding platforms out there where you can invest. Some cases lower amount, not always, but that's another way to get into a deal, is to go to a CrowdStreet platform and then invest that way. You may or may not have access to the actual syndicator. It just depends on the platform. You can Google things like that and then just ask around. Bigger Pockets is a great avenue too, if you want to post stuff out there in Bigger Pockets and ask to see any recommendations for syndicators and things like that. But there are really a lot of sources out there. Most people don't even know it's an option for them to invest in these type of deals. Almost every day I talk to somebody that didn't even know it's possible. I didn't know what syndication was until 2013, 8 years ago. But events I have found is probably the best way, because you get to meet the person face to face, which is a good quality to have when you're at an event.
Yeah, that is a good way to do that. And actually, there's a lot of opportunities for that these days that there really wasn't before the pandemic, because so many of these meetups are online and they are generally open to the general public. So you can meet a lot of sponsors much more readily than you could even before the pandemic. So good things have come from the pandemic. When a passive investor finds a sponsor and they are looking at some of the offerings that the sponsor is putting together, what are 3 of the biggest things that they should be looking for in that offering memorandum?
So in the underwriting, probably the most critical thing, and you do have business plan, which is an obvious thing too, what they plan to do. On the underwriting side, the number one thing, no matter what, on underwriting is going to be around the cap rate. What are they using? The cap rate will have zero impact on cash on cash, but it will have a potentially significant impact on your internal rate of return in the total return. So you want to know where they got their cap rate today, and then what do they project it's going to go up or down over time. Going up over time means that they're being more conservative, just so you know. So that's one. There are a lot of rules of thumb around how much income growth can handle in a given year. We see stuff all over the board, but if we see, let's say, for example, income growth of 8, 9, 10% in year one, which could be doable, you want to maybe ask it, and then it keeps going up to that amount pretty much every year. At some point in time, it becomes stabilized. So after the 2-3 year period, you would expect to see things like income growth to level out to 2-3%, typically not higher than that. The other thing would be there are a lot of things around expenses, and you don't have to know all the ins and outs of that, but you need to understand how do they construct their expenses. Because if you think you have money coming in, you have money going out. And one of the biggest things you want to make sure they accounted for is, do they have a property management budget from somebody, and what does it look like? Property taxes, probably one of the biggest things that some people get caught on. They don't actually do their due diligence to figure out how much, if at all, property taxes are going to go up. And there's just a lot of other things, right? Break even occupancy, break even rents, those type of things. But the income growth, a lot of people will try to double dip in my mind. They'll say, oh, we're gonna add all these other fees, pet fees and covered parking and whatever might be, internet, and then we're also going to push rents $100 a month. So the gradual increases that have to happen, a lot of people, they do it year one. They assume if it's $100,000 increase in income year one, and next year it goes up a little bit, like 2%, it's not possible as a general statement. It takes you 2 years or so to achieve those increases in income as a general statement. But we see where people will add it all up front, and that makes a huge impact on your returns in that way.
So when they do that, rather than increasing income, what happens? People start moving out? Is that what is the general rule?
The reality is if they do both, it can happen. But I'm saying too that it doesn't happen right away, because generally you can only do that when a lease is renewed or a new tenant comes in. But yes, to your point, if you double it up with other income and also rent, I'm not saying it's impossible. We've done it on deals. We're doing it on a deal right now where rents are substantially lower, and we're also doing other income. But we're doing it gradual. If the other income is going to be $70 a month per unit, we're doing it gradual. Maybe it's $25, $30 initially, but we're actually pushing rents $300+ on this property. But if everyone else in the market's doing the same thing, a lot of tenants don't have a place to go. They might get upset about it, and you're running a business, you're not running a charity. So they might get upset about it, but if they try to want to live in that area, they go down the street, they realize everyone else is doing the same thing. I wouldn't be the first person trying all those things. You want to have data points. Other people in the submarket are also doing that as well.
Good suggestion. We'll be right back after a word from our sponsor.
Would you ever invest all your money in a single stock? Very unlikely. Yet investors are willing to risk $50,000 to $100,000 in a single property in real estate all the time. Avestor is the world's first customizable real estate investment platform. Investors can build their own custom portfolios, selecting investments across multiple asset classes such as single-family homes, multifamily, student housing, self-storage, and shopping centers. You can also invest across multiple markets and different time frames. Avestor also enables other real estate entrepreneurs and syndicators to build and use Avestor's infrastructure and cloud platform to create their own customizable real estate funds. To learn more, visit us at avestorinc.com. Avestor, real estate investing made simple.
What are the biggest pitfalls that a passive investor needs to be aware of when looking at offering memorandums?
And we talk to them too, a lot of them will just look at the total return for the 5 or 6 year hold period. And they'll add an investor. He invested in several deals. I've known him for 20 years. And he said, why wouldn't I just pick, you have like 3 deals out there. Why would I just not pick the deal that has the highest 5-year return? Well, there are a lot of reasons. One, cash flow could be low on it. You don't know. But I think investors they fall into a deal and they're like, this is the only deal out there, so I better invest in it. But they don't really give as much thought about what is their criteria. Is it cash flow? Is it total return? I can make a 2% cash flow deal, 2% annualized, have a 300% return over 5 years by changing the cap rate down. I can do that. Is it correct? Probably not. But that's a big pitfall, is just trying to jump to see what does it look like at the end. And like I said, a lot of them they don't necessarily, I have people say, oh, I'm really interested in cash flow because I'm getting ready to retire. And we have some deals we've bought. One we bought recently is 0% occupied. We're not going to cash flow for 12 to 18 months on that. So we're doing rehab quickly, which is a benefit. But you need to go into it with picking the deals that make sense for you and your investment criteria. And then I think a lot of it is just not having even the basic understandings. They fall in the pitfall. They look at something and they'll even ask for stuff, but they have no idea what they're looking at. If you're going to ask for something, but there are some just general high level rules of thumb that you can look at a deal to say, either I'm going to ask more questions or it looks right. Expense ratio, just take it as an example. For a lot of markets might be 50% of income. The general rule. Some markets are higher, some markets are lower. But if you see expense ratio for 35%, you might go, well, why is that so low? Did they forget something? We have properties right now run at 38% expense ratio. There are reasons for it. We have some run at 60%. But if you take a general rule of thumb, 50%, you can say, okay, why is yours lower or higher than that, and get explanation. Or rent growth let's say after year 3, you see something higher than a 2 or 3%, you want to understand why that is. So I think they fall into, frankly, they're getting sold a deal based on a presentation or webinar or what it might be, but they don't truly know what they're looking at. That's the biggest issue I see.
So education is a key factor. This is interesting to me. You just purchased a zero occupied complex. Can you take us through that acquisition and what was interesting about it, and why in the world would you purchase a zero occupied complex?
Yeah, no, for sure. So we bought properties that are 96% occupied, bought property before 26% occupied. This is actually two properties right next to each other, joined together, same seller. One building is occupied, the other one is zero. The thing I like about it the most, I'd rather be 0% than 30, 40, 50%. Because if it's 30, 40, 50%, whatever the number is, pick a number, you're actually trying to, and it might be that people are in the building, right? It's not like one building's vacant and the other one's not. So that's a little harder to try to get CapEx projects done that way. Plus, it doesn't look as good. You have people living there and you're trying to close off buildings and fence it and things like that. With a 0% occupied building, it's strictly a function of the operator. We bought it from the seller, really just letting the property go. It's in a market we're already in. It's with a management company that we have, a property management company that we've used for years, and they've done tons of CapEx projects for us. So when we looked at it, that by itself didn't really make me nervous. We had just finished a project. It was over a 560 unit deal. It got down to 28% occupied, but we were doing CapEx 35 to 40 units a month, which is a lot. That was $21,000 a door of a unit rehab. Again, a lot for a multifamily. Picked up the same team from that property, put them over on the other property, same management company, same construction crew, everything like that. So that gave us a lot more confidence in our ability. In fact, we just closed on it not that long ago, really, and the general contractor that we use thinks he's going to come in 2 months early on delivering all the units. So that's a benefit. Plus, we were able to already start leasing some of the other units at the other property for our pro forma rents, which is good. We didn't even do the exterior work. I would not suggest a really low occupied building necessarily for anyone starting out unless you have a construction background. They're more difficult. They just are. A lot of the ones we've done have turned out really well, but they can take more time, cost more money, more headaches. Starting out, I would probably focus more on trying to get that single or double, if you want to say, type deal. As an investor, I'd be pretty leery. There are a number of people I talked out of investing in deals before, because if it's their first deal, they'd really need to understand the risk involved. And yes, we do think we can perform on it, and we think we can return a large percentage of the capital pretty quickly, relatively speaking, 1.5 to 2 years most. But we could also run into problems. So that's a riskier project.
Yeah, that's the risk with any kind of heavy lift like that, is there's so many unknowns, even for an experienced investor like yourself there.
There are.
But that certainly is a very excellent example why you really need to know the syndicator, because a totally inexperienced and new syndicator could have been the one purchasing that property. And there's just so many things that can go wrong. That is, if you're investing with a novice syndicator, that kind of heavy lift is a huge risk.
It is. And even as an investor, people can make their own financial decisions, but I would probably try to mix up. If you're looking at investing in 3 or 4 deals over the next couple of years, whatever it may be, I would probably mix it up with different types of deals. I personally wouldn't say I'm going to do all these risky deals with all 3 or 4 deals. I'd probably pick one deal that, if you're comfortable with it, that looks maybe a little bit, it is riskier, and the other 3 that maybe aren't as risky. And you can always look back on a project and go, man, I wish I would have put all the money I had in that deal. Yeah, we all can look back and say that. The reverse could be true. Man, I wish I didn't put any money into that deal. So don't beat yourself up or anything like that. Looking back at it, you're trying to make sound business decisions, financial investment decisions, and you can't look back on it after the fact and keep being like, oh, I wish I would have done this or that. You just have to move on.
Enlightened investors will be right back after this important message. I hope you're finding today's show informative and enlightening, and that you will please take a moment to find us on Apple Podcast and leave us a review. Each week for the first 4 weeks of the launch, we will hold a drawing of all those who submit reviews. The winner of the drawing will receive a $25 Barnes & Noble gift certificate. Reviews are very important for growing our audience. Your review will be immensely appreciated and will help others find their avenue to financial freedom. I was talking to somebody yesterday, and they said one of the first things any investor needs to do is to define their criteria and stick to it, and don't look back. So good suggestions there. Before we go into our last segment here, Mark, share with our viewers and listeners how they can get in touch with you.
My email is Mark, M-A-R-K, at thinkmultifamily.com, and the website just thinkmultifamily.com.
You have a lot of educational information, so tell our viewers and listeners a little bit about multifamily or about Think Multifamily.
Sure. We purchase properties as far as one of our main focuses, and we also have an educational group, and we hold events. We teach other people how to, syndicate, do deals similar to what we do, and help them, coach them in that respect. And then as far as we have a fair bit of free content out there too on YouTube and things like that to try to walk people through the different steps of purchasing apartment complexes and some things to look for. And we also have some things around, like I mentioned, tricks that some syndicators play that you need to probably be aware of when you're looking at deals. But so acquisitions, we're in 9 states. We've done over 10,000 doors. We have probably 8,000-ish, a little more than that now. And then the education piece has been a huge aspect. And the only reason we started education, had no plans of doing it, was we felt that a lot of the education was either lacking because whoever's doing it, they either don't care, don't know, one of the two, or both. And then a lot of people don't share things that everything's hunky-dory. So nothing ever goes wrong. It's not reality. So we will share things, problems we've had. We just had training for our group, our coaching group, and brought up 4 different people raising capital. We raised a lot in the first quarter, but I brought up the people that struggled the most to raise the capital. No one has never not closed a deal in our group from raising capital, but you're going to learn a lot more by hearing those stories of what did they struggle with, why, and there are reasons why, and what did they do to overcome it.
Excellent. Mark, share with us one of your most difficult setbacks in life, and how did you come through that time, and what did you learn from that?
From a personal standpoint, biggest setback was I had an IT business, and I was doing probably pretty well financially, things like that. But I worked 90 plus hours like every week, like not joking, sleep 3 hours a night, and it caused a lot of issues personally. Time I had, I'd spend with the kids because I'm like, the kids are small, they're going to get big and then move out. But I ignored my wife, Tamil, caused a lot of issues several years back, 5-6 years ago or so, and to the point where she's like, you need to do something different or else. So that kind of, as a result of that, we ended up doing syndication, started Think Multifamily, and my wife is 100% full-time in the business. Marriage is the best it's ever been. Been married 26 years, which is great. But that was the biggest setback from a personal standpoint. And that setback was a result of me really not being able to turn off my work, frankly.
It's a good thing you found your way out of that and strengthened your marriage rather than letting it fall apart.
Sure.
How are you putting your success as an investor and entrepreneur to work to create universal well-being and abundance for all beings?
Yeah, the coaching piece is not something we need to do. We don't need to do it. Yes, we charge for it, and it's one-on-one coaching, but it's not something we need to do in order to have a good living. So that's something that we provide back. And then outside of that, you never really know. I never knew, I should say, I shouldn't talk for everyone, that what would happen as you start generating a little more income and wealth and things like that. Growing up, I was always fearful and petrified of not having enough money. And thankfully, we've been able to give back to other charities. We support some orphanages. Our friends they have an orphanage they opened up in the Philippines. We've been supporting orphanage in Nigeria. My wife's been over there a couple of times as well for 15 plus years probably. And then, so orphans, and the other one, the sex traffic industry. We have friends that have started an organization here locally in the Dallas area for sex trafficked women. And we've been able to contribute a fair bit to that. Whatever your passion is, there's nothing wrong with starting out with being money focused. Hopefully people aren't. That was my main driver when I started my career. But we got to the point where it's like, there's a lot more to life than money, and having a position where we can give back, in some cases, probably more than I ever thought we could give back to other less fortunate people, has changed my life personally for the better.
Sex trafficking is an issue that most people are shocked to realize that it actually does go on here in the United States. And it's not just, it's all over the United States. It's under our eyes and our noses, and most people have no clue that it actually is transpiring. So good work there that you're doing, and certainly good work there with the orphanages. Well, Mark, imagine that you've come to the end of your life, and as you look back on your life, as you lay on your deathbed, what do you look back on with your greatest joy and sense of satisfaction and fulfillment?
Yeah, I've done more reflecting on this more recently. My dad passed away a little over a month ago, and looking back, now it's caused me to do a lot more thinking. Plus, I'm turning 50 in 2 weeks here, so it's one of those things where I do a lot more reflecting on it. For me, there are earlier times in my life where I'm like, I wish I wouldn't have done this or that, as far as working so much. And end of the day, I've gotten to the point where you can't go back and change the past. That has made me result of who I am today. And frankly, there are a lot of things in my life today that are great that maybe wouldn't be if I didn't go through some of those things. My number one thing would be is knowing that I'm going to heaven, that I love Jesus and that I have a relationship with him. Number one. Number two would be that I've done whatever I could as a husband for my wife. And like I said, everything has been great for quite a while now, but we had a number of years where it wasn't. I want to give my time and energy and things back to my wife, Camille. And then third would be the kids, that never going to be a perfect parent, but I want to be the father that was always there for my kids, never critical of them, never try to be lack of understanding. A lot of things they go through are the same things that we went through as kids, maybe even adults. And then friends. To me, I always had a work ethic. I worked my butt off, and I got a lot of self-worth out of work. Now I want to flip that upside down to where my self-worth is coming from giving back to other people, and then having a family that loves me and that I love, and then friends that surround me that I have a relationship with and living life with, rather than being just superficial where I was for a number of years. And then the business is secondary.
Mark, it has been a pleasure being back with you again today. Thank you for sharing your real estate wisdom and sharing a part of your life with us as well. So thank you, Mark.
Thank you, Alan.
Thank you for tuning in to Real Estate Investing Abundance, brought to you by Steve Talker Capital, a company working for passionate professionals like you to develop financial independence built on solid, passive real estate investments. As part of our efforts to make the world a better place, Steve Talker Capital contributes to activities and organizations committed to better understand the equine. These endeavors attempt to enhance the human treatment of horses worldwide. Steve Talker Capital, working for a world where all creatures, great and small, flourish abundantly. For resources to develop your financial independence, connect with us at stevetalker.com.